Markets declined for second consecutive session, this ahead of US Federal Reserve's decision on interest rates later in the day. Realty media sectors advanced, whereas metals fell the most. Agam Vakil with the wrap of all the market action.
Well, thank you for that. We did see weakness in Indian markets along with the Nifty, which declined by around 0.5% in today's day of trade, closing below the mark of 19,000. And the Bank Nifty also, on account of weakness in several private sector banks, did decline by around 0.3 of a percentage point. In the broader markets, we did see weakness once again as far as the mid-cap and small-cap indices go, though they did outperform to a certain extent, but declining by only around 0.2% each. Moving on to some key sectoral movers, we had strength in Realty and the media indices, both of them advancing by around 0.5% to around 1.2%. And as far as your sectoral losers go, well, we did have markets being weighed down by the metal index along with the auto index. Coming down to your key index movers, some strength being lent by large pharma major Sun Pharma, which was up around 2.5%, with BPCL and HDFC Life also lending some amount of help in terms of keeping the index in check. But on the losing end, we did have weakness in Adani Enterprises, Coal India and Tata Steel, all of them losing anywhere between 2.5% to around 3.5%. As we move into trade tomorrow, what are we watching out for? Well, it will be the Federal Reserve, the policy, the change in interest rates, if any, and of course a lot will be focused on the Federal Reserve's chairman commentary as far as your interest rates going forward are concerned, which would of course determine fund flows in Indian equity markets. And that's what we're going to watch out for. And with that, it's back to you.
How can investors navigate market volatility to find pockets of value? How will markets perform in the near to long term amid current global economic conditions? Market veterans Vikas Khemani and Rishabh Sheth share insights.
Right now where the markets are, probably it's one of the, today the fear factor is very high even in our market. But the good news is that if you look at, and investing in my opinion is all about long term. You look at 3, 5 year, 10 year kind of horizon. And these are the times when they offer you this kind of exciting opportunities. And I do believe that India is in a transformative phase. What we are seeing ahead of us over next 1 decade is phenomenal. I think we will see a massive wealth creation opportunity ahead of us. Country will leapfrog. Our economy will go to $5 or $6 trillion, and that will lead to massive wealth creation. So when you zoom out, right, then you see this massive wealth creation. But when you zoom in and start focusing on a short-term horizon, then you start getting worried. So my only suggestion to everyone is that zoom out. Don't focus on short-term. Don't focus on. When you zoom out, you will see the enormous possibilities, enormous opportunities. And if I have a capital which is 5, 10, 15 years, I don't need to worry about, if I buy something, it goes down 5%, 10%, shouldn't bother me. Should be fine, because ultimately the end game or eventual journey looks pretty bright. So I would say zoom out and, stay focused on the medium to long term.
Don't miss the forest for the trees, right? We keep it simple in terms of what we are looking for in our investment thesis. We are very clear that we can only choose the team which kind of can navigate through all this. From our perspective, having seen this for 30 years, we know that this is going to be a constant. Change is a constant. Things will keep happening in the environment. Narratives change. Last year was high commodity prices. This year it's a different narrative. Of course, higher interest rates is something in at least the developed world which maybe a generation of people have not seen. So my sense is, from our perspective, we keep it simple. We try and ensure that we are focusing on companies where we understand the businesses, where the underlying managements are continuing to execute on the ground well. And that to us is very important, because at the end of the day, India is a growth market. And if businesses are growing and continuing to execute well, you will get your share of the returns.
And Indian Telecom infrastructure company has posted strong growth in the July-September quarter. Revenue, profit and margin saw double-digit growth. Here's Chairman and MD Sanjay Kumar on how the company's guidance outlook for the coming future is.
Revenues will maintain the guidance of 25%, and margins also 18 to 20% the same which I've been maintaining, and will of course have to. It's not easy task when you are shifting towards project from telecom side. The telecom proportion as an overall kitty will certainly reduce, but we will be handling it, and we are sure that we will do that.
And sales in Mumbai have seen a sharp uptick. The financial capital's property sales in October reached an 11-year high with a 25% surge in registrations. Here's Gulam Zia explaining the key trends that have led to such a strong surge. Listen.
Prior to pandemic as well, the residential real estate was in dumps. Actually, year after year, it was shrinking. Number of sales, apartments was actually dropping year after year. While that was an era where the economy was doing well, stock exchange was doing well, there was a lot of wealth creation, salary rises, and all that was happening, but home sales were not improving. And post-pandemic, while a few of one of the hypotheses is that people wanted to get bigger homes, work from home, etc., compel them to do that. Whatever the case may be, the reality is that all those guys who didn't buy the homes when they had money are today buying. And that is continuing in spite of the home loan rates shooting up so much, perhaps highest in last almost about a decade and a half or so. In spite of that, there is no letting up. So the number of sales have been shooting up month after month after COVID for sure. And in last year and a half or so, especially in mid to upper end, the activities are far better than what we have seen in last year and almost about decade and a half or so.